Howdy folks, welcome to yet another edition of Smarter Money Matters. It really does. I'm your wealth doctor, Jeff Camarda, with our super CFPs, Lou and Anna. And we're continuing with our theme of winning with Camarda. But before we get into this podcast topic, I really want to remind you to start watching, start following, and sharing this concentrated wealth education we built called Minute Wealth. We're publishing, by the time you see this, probably 2 a day, 1 a day since January of this year. Short videos, typically 60 seconds or less, really concentrated information on Roth conversions or taxes or business acquisitions or real estate investing, all kinds of really interesting, valuable stuff in 60 seconds or less. I call it, exceptional expertise in 60 seconds. Actually, exponential expertise. So go to thewealthdoctor.info, thewealthdoctor.info. I should start wearing my lab coat on these things, so I'll run to the office, to get a taste of this. I think you'll find it really, really cool, and you're going to want to follow it and share it with your friends and family. All right, so continuing with the winning with Camarda concept, the fourth thing that really sets us apart from most other advisors is we are very, very proactive money managers. And we run with something like 12 different portfolios, all in-house. These are ours. We're not, putting our name on something. The decisions are all made completely in-house with our team and my smarter brother, Jonathan Camarda. And one of the really defining aspects is the application of technical analysis. That's charts and indicators and trend lines and momentum and that kind of stuff to help guide our downside protection strategies, which is really, really important. You've probably all seen this brochure, and there's a graph here, which hopefully the camera will be able to pick up. But if you look at where that big red arrow is, that was the last tech crash from 2000 to 2003, where tech stocks went down something like 80% within a year and a half or so. By the way, newsflash, everything is tech these days, right? Even my glasses probably are tech by next year. So technology pervades life, right, in businesses. Went down 80%. It took something like 16 years just to break even. So when market plunges and panics come, the downside can be enormous. 1929, the dot-com crash I just mentioned, the Great Recession crash of 2008. These kind of episodes really are, inevitable. Certainly have recurred constantly in human history. You never know when one's going to happen, but when they do, and if they happen at the wrong time, like around retirement, it can be devastating. So we are, in many of our portfolios, we applied methodology that is intended to spot these market downturns in advance and take proactive action to protect you, from what could be a major slide. And with that as a bit of a background, what do you guys want to expand on that? Because you're talking with the clients about this stuff every day, right?
Sure. So I guess I'll go first.
Yeah, that's fine.
I guess you did.
We have different portfolios that are designed to achieve different things and to kind of look at different things from a tactical perspective. And they have triggers, they have indicators at different times when the market is going up and when it's going down to trigger to whether, either to buy into it or to sell out and get out, go to cash or something more stable during those volatile times.
And not just the market, right? Those are specifically probably different market sectors. And why don't you expand a bit on that?
Yeah, so again, different portfolios, some that are kind of more tracking the broader market and are slower moving. We have one that tracks, individual sectors that we will rebalance occasionally, trying to target the top performing sectors at that time or where we think, institutional money will flow. But it's a little bit quicker to get out of the market if we're seeing, some of these indicators, these technical indicators flashing that we need to. And then we have some portfolios that, are invested in individual stocks where we may, accumulate cash or use inverse funds or other, investment vehicles to stabilize those portfolios if things are getting, rocky in the markets. And then it also potentially buying in, right, with some of that cash, buying really quality companies when things are lower.
Yeah, so let me kind of, break that down. Some of the indicators like market looks like it's going up, you want to buy, looks like it's going down, let's get out. Sometimes there's sectors, like in the recent, the difficulty with Iran, where oil went really sky high for a while, and that indicator may flash as a buy, and other indicators like bonds and other inflation-sensitive sectors are a sell. So depending on a portfolio, we look at these indicators. And active capital preservation, one of our most conservative portfolios, is actually a very sophisticated hedge fund type strategy where some things are being purchased and other things are being sold, and some are offsetting because if this goes down, then this should go up in order to stabilize things. So it really gets pretty complicated, at a portfolio management level, or in individual stock portfolios. There may be 20 or so in OGI and
2025
in opportunistic growth and income, where we're looking to buy. It looks like okay, we should buy more. Others, gee whiz, it looks like it's peak, maybe it's going down. Sell that and buy something else going up.
Yeah.
So these indicators are selectively applied across a variety of different portfolio management disciplines in order to target better growth, smooth returns, and protect against significant losses. Is what the objective is, right?
Yeah, well, the objective really is, yes, it is that, but again, that's kind of where we, differ from other advisors, probably most other advisors. I mean, I don't know anyone that does it the way we do it out there.
True.
Right? So, where we're, trying to not just buy and hold and pray when the markets are going
Actually,
down.
let me pause you there for a second, because I hear the whole. Well, not really, but I think that's an important point. You hear America has been drowned in buy and hold index Kool-Aid. Buy and hold, eventually go back up, and in many periods it's true. Other periods it isn't. We call that hold and pray. If you look at what happened in the 1970s, or in 29 through the 30s in those bear markets, buying and holding and praying, you would have been praying, but you would have died. You would have died anyway, right?
Well, like you said, if it's right before your retirement, or in the middle of your retirement, and you need to draw the income.
That's a good point. You want to expand a bit on that?
Well, absolutely. If the market dips all of a sudden, and you're praying for it to come back, and it takes 5 years for it to rebound.
So what do? You put your life on hold. How do you buy groceries and stuff keeps going up? So security's not enough. If you're having to spend money on a portfolio, and that's really called sequence of return risk, right? Is having to spend money in a portfolio at the same time it's going down, you're cashing in shares at cheaper prices that will never have any hope of bouncing back, regardless of the time frame. You want to button that up for us, Ms. Wunderlich?
Yeah, I mean, buy and hold portfolios, they work until they don't. What if you're in a situation where, the Federal Reserve is increasing interest rates, so you have bond prices going down and likely growth stocks going down, right? Well, if you're in a buy and hold portfolio with X% bonds, X% in stock or equity funds, right? Both of those are going down. It's not stabilizing. So, the tactical management that we do involves shifting things as needed as the overall environment changes.
Okay, well said. So that really, just to kind of put a bow around this, one of the 5 defining principles of the Camarda difference, which is drop dead fee only fiduciary, no commissions, trained like no other advisors we know, PhDs, CFPs, CFAs, all kinds of stuff. The fact that we offer total wealth care, advice not just on portfolio, but asset protection and taxes and estate planning and risk management and insurance or retirement funding, all the kind of stuff we talked about last week. And the 4th difference is ongoing active management. The 5th difference, which we'll talk about next week, is are really the constant national recognition, which is also we're very proud of, and also they're quite unusual in the advisory space. But any afterthoughts though before we leave them to get back to their Saturday morning paper or whatever?
Yeah, no, I mean, for clients that are clients already, they should be, I guess, proud of themselves of, for selecting and working with an advisor, and most of them.
But by gosh darn it, folks, we're proud of you for being smart enough to pick us.
Absolutely.
Thank you.
But also, they've had, firsthand, have seen the power of this proactive management that, we've been able to achieve just, this year in 2026, from January until kind of mid-year now, and hopefully that continues.
Hopefully, I think probably to expand on that. We're the beginning of the Iran war, where the downside indicators flashed and we got out, and then they flashed. Okay, it looked like it was kind of a head fake, and we're back in an uptrend, and we got back in. We think that worked brilliantly. It's not always that perfect, but that's really the sort of result that we aspire to. Final word, Anna.
No, it's been good conversation.
In that case, that's all, folks. See you next time. From Dr. Jeff and Lou and Anna, thanks for watching. We'll see you in a week. Bye-bye.